Michael, what just happened?
I think we're seeing yet another day where there's this volatility. We're here celebrating that the Dow had this 865-point swing to the upside. All I can say to that is it's not healthy. It's one thing to say that we closed well, and maybe that's a good point, but overall, this volatility is not healthy. Call it what you will, but these moves tend to beget more moves like it.
May not be healthy, but I think a lot of people were waiting to see whether there would be some follow-through buying to yesterday's more than 1,000-point move, and we got, Nick, the back-to-back confirmation within the S&P. We haven't seen that in a while, so what does it mean?
No, it is healthy that at least we were able to tack on a second day of gains. And I think what's happened is we had a massive month of tax loss selling, and we're finally getting through that. And we should have a little bit of clear air now for the rest of the month and into that first week of January, now that all the selling of all the losers, small caps, mid cap, large caps across the board is finally washed out.
But Michael, do you think the data has justified today's rally? The last couple of bits of data you've been keeping an eye on have gotten worse.
Yeah, the big worry I have, first of all, like longer term, I'm still very bullish here. I still believe in the U.S. economy. There is growth that's slowing, but I don't think it's slowing to the point where we're going to see a recession. However, I'm also a big believer that what happens in the markets does drive the data. Earlier this week, I pointed out that I'm very concerned about tomorrow's Chicago PMI. It had a 66 handle last month. Consensus is around 62-ish. I think it's coming below 60 because I think purchasing managers are watching their stock holdings, their 401ks go lower. It's making them nervous. It's making them nervous about spending money on a job, if you will. After that, we have the Dallas Fed on Monday, and we have the ISM manufacturing right after the new year. Yesterday, we had the Richmond Fed, which came in at a -8, and that was the biggest drop we've ever seen in that number month over month. So things like that do worry me. This market needs to stabilize.
Or no?
What's that?
Isn't that already in the market, that kind of bad news?
It's already in for what we've seen, but what if that data gets worse? Worsening markets can keep driving that lower is the point. I don't think it's going to, but that is the big risk here. The market's driving the data, which drives the markets, and so on in a vicious cycle, negative feedback loop.
Nick, you mentioned the effect that tax selling has had on the market. So do you think there has been a big calendar effect on the selling, and that across into the new year is a catalyst for a significant move to the upside?
Yeah, it has absolutely been very important to December's action. If you look at the top 10 losers of the S&P, they were down 23% in the month of December through the 24th versus just 14 for the market. And you do have this classic January effect, one of the last sort of strange oddities of the U.S. stock market that does see small cap stocks that have been really beaten up from tax loss selling rebound in January, and you can paint that picture for the market as a whole through the next 10 days or so.
So are you guys saying, I can't figure out what you're saying, so with seasonal factors playing a role in these crazy market dynamics, are you saying January offers a new opportunity to buy or to sell?
That is the $64 question. All I know is that we've seen this tax loss selling. It's been profound. We are going to get a bounce. Past that, we're going to have to rely on the weaker data that was just mentioned to begin to pull Chair Powell into a more dovish stance for Fed policy come the new year, because that's the big wrinkle in the market right now.
That would be bullish.
That would be bullish.
You agree?
Yeah, I think Powell. I think Powell already is dovish. I think he flubbed it a bit last Wednesday. Did it justify that sell-off? No. Markets were looking for an excuse. There were other factors going on here. I do think that the new New York Fed Chair Williams, he did do a bit to sound more dovish. I think we're going to see more of that. I've been calling that for a long time. Back when everyone was saying 4 or 5 hikes like a jackhammer last year, I said this data's going to slow down. We need to hold off. Now let's see if that's what plays out here. Again, if the data keeps getting worse, let's see what happens. Maybe there will be a cut. I don't think that's priced in now. That's not my base case, but let's see.
If the data got bad enough for a cut to materialize, is that good for equities?
Well, certainly not, but we do get into the scenario. Remember, during the Bernanke days, we had the bad is good. The bad is so good that it's going to keep the Fed accommodative. And then the wild card here, Wilf, is that the president can stop with the border wall, get a trade deal done, and then also work with the other party to get some stimulus done. How about fiscal policy? Let's look for that in 2019 as well. That could be a positive catalyst that we haven't thought about.
So lots of ifs there. Are you buying equities in general for the next couple of days?
In general, I'm still picking away here, but I see the seasonals that Nick pointed out, and I do have to say that year end could be the end. Today, maybe it was today. Maybe it's going to be Monday. Maybe it's going to take a few days. Again, I want the market to get boring here for a few days. I want to be on the show saying, yeah, the Dow is up 40 points. That would get me excited about this market. We need a few days of that. It would show me that the bloodletting is over, and perhaps it was time for everything to scale off. The data would respond to that as well.
Meantime, new data shows a growing apprehension as investors pull back from markets this year. Money flowing into mutual funds and ETFs dropped 62% from last year, which is the biggest decline since 2008. Still showing money flowing in, though, if I'm reading that correctly. So it's not quite a decline overall. It's a decline in the rate of inflows. Guys, nonetheless, clearly lots of people talking about the fact that cash now offers a 2% alternative. S&P 500 dividend yield is lower than that. Nick, do you think this is something that's a big factor for equity markets going ahead, that you've got that relative attraction now of bonds and cash?
It absolutely is, both in terms of bonds, short-term bonds, cash, and even longer-term bonds, providing that safe return. The issue with these numbers are twofold. The first is stock buybacks are still the most important number to watch because they're running close to $1 trillion a year versus the 250, 260 number that we just talked about. The second is that persistent move to passive investing, which is very tough on active asset managers in terms of drawing in new assets, and makes the market feel like it's more on autopilot than it should be.
What effect do you think it's having on the individual investor, Michael?
The shutdown. Well, I think the issue with the shutdown is this. Psychologically, it's not good to see. I don't think it's a big factor here. The one thing it is going to do is we're going to start hearing in January about the slowdown in Q4, because the end of December we did see some slowdown in activity. The thing I'll say about that is we need to remember, for a lot of that, there will be a pickup in Q1 in terms of a lot of time being made up. We've seen that happen before. It's a minor phenomenon, but given how sensitive everyone is to the data right now, we could see some sort of pickup right now, and we'll see how that plays out.
When you see this volatility pick up, Michael, do you ever get worried that we're going back to comparisons of sort of 07, 08 and the run into that, or are you not worried to that extent?
The thing that I always say about that is this. I'm like, you know what? It's not 2008, but it is 2019 coming up right here, so we need to be concerned with that. What's the big concern? One thing that's not getting a lot of attention is at the financials. There are all these leveraged loans that we're hearing about that are being held on the bank's books. What's going to happen with that paper? Personally, I've been negative on financials all year. I'm waiting for an opportunity to get more positive on them. It hasn't happened. The trade has played out pretty well. Let's see how expectations are looking into Q1, but that is a big factor. What is that loan going to do? However, that's not going to push us into a 2008 type scenario. But again, let's see, if market volatility, market structure being broken, all these moves up with the passive flows and the ETFs that Nick pointed out. Let's see, where that all goes. That could end up being a huge risk factor that leading to something else. I don't think we're looking at 2008. I don't think we're looking at recession here. It's not a very, very likely scenario to me.
Nick, I think of your research and your work as sentiment data. You've got a good feel for what people are Googling and looking at. How bad has it gotten amid this sell-off?
It's not good for two reasons. The first is regular retail investors are Googling things like Dow Jones and stock market at levels similar to what they did back in February, and they've been nervous all year long versus the prior 3 years. So sentiment's definitely on edge there. The second thing is they're Googling recession by 50 to 100% more than just 90 days ago. So there is, for the first time in the last 5, 6, 7 years, the real worry in the population that the volatility that we're seeing will drive a recession next year, and that's bad for consumer sentiment, bad for consumer spending, and bad for business investment as well. So we're right on a knife's edge.
Sort of gets to this idea that it could be a self-fulfilling prophecy at some point.
That's the concern.
Negative feedback.
And in terms of which sectors, Michael, from here that you would be buying, which are you focused on?
Yeah, look, I still say that if growth is becoming slower and then growth is scarce, go for where the growth is. Personally, I think we pointed out earlier in the show, Jackie pointed out stocks like Applied Materials and KLA 10 Core and MU, so equipment and memory stocks. Within tech, I think those are interesting. I think they've been sandbagged. I think that there's a lot of growth potential there. I still like healthcare going into 2019. I also like real estate, given my views on the curve, given my views on that as an asset class. So I'm good there. I'm still negative on financials, as I mentioned earlier. I'm still negative on industrials and materials, although they'll probably get some kind of knee-jerk higher if the Trump administration ever gets around to the trade deal with China.
Which sector are you watching, Nick?
Defensives. We still like defensives here. We're pretty cautious. And even though healthcare would be an attractive group, it's right at the upper end of its historical band as a weighting of of the S&P. So we're nervous about that. It just tells us it's better to hold off and wait through Q1, let this volatility wash out.